So where do you save your money? If you're like most people, you save your money at a bank. That's what we've been taught to do. But when I tell people what banks do with their money, it sometimes surprises them. It surprises them to know that banks actually grow and store their capital outside of the banking system. As a matter of fact, banks store a large portion of their money in life insurance. Specifically designed and engineered whole life insurance to be specific, and it's called BOLI, B-O-L-I. And you know something else? The banks own a lot of it. So around the start of the financial crisis, banks actually accelerated the purchase of whole life insurance and their life insurance assets called BOLI. And they did this because they were looking for stability and predictability during these hard times. And during the Great Recession, BOLI outperformed banks' traditional assets of stocks and savings mechanisms that you typically are told to put your money into. Life insurance actually beat them. And it provided that stability that the bank was really looking for in these really difficult times. To the tune that during the Great Recession, banks actually increased the amount of BOLI that they owned to, I believe, $180.5 billion at the end of it. And they continued to buy more and more of this asset. So a lot of people say, I've never heard of BOLI. So what is it? BOLI is life insurance purchased by the banks on their key employees, their vice presidents, anybody that they can call an executive so they have an insurable interest. And why do the banks do this? Well, they do it to offset their costs for their health insurance, their employee benefits, 401k programs, and also, and sometimes I think most importantly, they do it to satisfy their capital requirements. That's a huge thing. Because banks need safe places to put money to support these capital requirements that are required of them, and this is where the banks choose to put that money. And people often ask me, is this common? Why haven't I heard of this? Sometimes the things that we need to know are the things that we don't know. The majority of banks in the US, including about 3/4 of the banks with assets of $500 million or more, hold life insurance as a general asset of the bank. So banks buy life insurance for a lot of reasons, but most specifically, they buy life insurance because life insurance offers things that their traditional bank products do not offer. Things like tax advantages, guaranteed growth, where bank products that you and I have been taught to put our money in typically offer low rates and high taxes. So again, here the banks are doing the complete opposite of what we're taught to do with our own money. And it sometimes really frustrates me that this is how it works. Another thing that's important is banks use this specially designed whole life, these BOLI products, because they're so secure and so reliable that they can actually be used as collateral for other things the bank's doing. The BOLI products offer returns that are far superior to what the bank offers. Bank products have low rates and they're taxable. Whole life insurance offers guaranteed growth, tax advantages, and it also offers an opportunity to shore up balance sheets with an asset that is so reliable it can be used as collateral. Banks are banking on a return. It's all about the Benjamins, isn't it? The most common reasons cited by bankers for purchasing BOLI are that they provide competitive returns with superior credit quality, and that's a report by bankdirector.com. So check this out. According to BOLICOLI.com, BOLI returns typically exceed after-tax returns of more traditional bank investments such as municipal bonds, mortgage-backed securities, and 5- and 10-year treasuries by a margin of 150 to 300 basis points. That's the same as me saying 1.5% to 3% annually. The favorable tax treatment of life insurance has a sizable impact on the bank's returns. In October of 2016, BankDirector.com confirmed this. Current BOLI net yields are in the range of 3% to 3.75%, which generates tax equivalent net yields of 4.85% to 6.05% for the bank in a 38% tax bracket. So that's basically like me saying you'd have to earn 4.85% to 6.05% on your investments to earn the same thing that banks are getting with these BOLI products, earning 3 to 3.75% because of the taxable advantages they get with these. Life insurance also offers a measure of safety for the banks. Let me give you an example. Tier 1 capital represents a bank's equity and reserves, and it's the core capital that's the measure of the bank's financial strength and how well protected it is from the risks that it takes. Think of 2008, right? Banks almost had a complete collapse. Their Tier 1 capital was one of the only things that protected them, and they didn't have enough of it. It represents the highest quality capital that, from a regulator's point of view, is essential to the health of the bank. Boy, where was that then? Since the policies are considered somewhat liquid due to their cash surrender value, they can be counted as Tier 1 capital under the new requirement rules. So pay attention, this is important. According to the 2016 Equity Alliance Michael White's BOLI Holdings report, the FDIC asset concentration guidelines are 25% of the Tier 1 capital. This means that the cash surrender values can provide up to 25% of a bank's top shelf capital. Banks find BOLI an attractive Tier 1 asset, primarily because life insurance companies typically don't take short-term risks. They invest for the long haul. And not only that, they're not leveraged. This makes bank-owned policies a low-risk, high-quality asset for the banks. As the financial author Barry James Dyke mentioned in his article, he said that if banks are holding this much whole life insurance, then why are we taught to do the exact opposite? This is exactly what I was saying at the beginning. We're doing the opposite and taught to do the opposite of what the banks are doing. There's something wrong here. Unlike traditional banks, if a life insurance company has $1 million on deposit, that life insurance company may loan no more than $920,000, and usually only a fraction of that. As such, life insurance are 100% reserve-based lenders, which makes them stable in down economies. Remember, banks do the opposite of what life insurance companies do. The big lie we've been taught, which is the double standard if you ask me. So banks' retail products are things like checking and savings accounts, CDs, credit cards, mutual funds, and mortgages. You can walk into any bank and get those financial products. But what would happen if you walked into the bank and you sat down with the teller and you said, I would like to put my money the same place this bank puts their money? They couldn't help you because they don't offer the products of where their money goes. Because they don't sell the financial product that they use themselves to grow cash reserves at rates higher than that of bank savings accounts, or enjoy tax-deferred growth and often tax-free gains. How about build tax-advantaged cash positions much faster than that of a traditional retirement vehicle because of the contribution limits? Increase the liquidity and stability through building a cash position, fund future needs and prepare for rising costs through inflation, beat or pace inflation, and protect themselves from an unexpected loss of a key employee, also known as providing a legacy. So as Denver Noax of The Wealth of Life explains, he says that banks, when it comes to investing their own money, banks don't follow conventional wisdom and put their cash into mutual funds, stocks, hedge funds, term life insurance, or risky real estate deals. Instead, they place a large portion of their vital reserves, known as Tier 1 capital, into high cash value life insurance or permanent life insurance. You see, banks invest billions into high cash value life insurance. Surprisingly, for many banks, life insurance is their largest asset class. So BOLI, or bank-owned policies, are not the same regular life insurance policy that the average person would buy. If you just walked into your life insurance store, called your agent or your financial advisor, you walked into the bank to buy that new special life insurance policy, they would probably not know what you're talking about. You see, these policies that the banks use, that the companies use, that the credit unions use, and the wealthy, are designed for high early cash value. These policies are designed completely different than the ones you're used to. The question is how do you figure out how to design one that works for you? And the answer is find companies that know exactly how to build these policies. Companies like the Money Multiplier that absolutely can design a banking policy the same way the bank does this. Another key difference between the BOLI policies and a policy that maybe you could set up to mimic what the banks do is BOLI is highly regulated. Your policy that you do for your privatized banking is not regulated. You could use your policy to pay off debt, get all the money back for all the cars you're ever going to buy, drive, and own. You could use it to fund home renovations or anything you would traditionally use the bank's money for. You can take back the banking functions in your life by doing exactly what the banks do every single day of every single year. So what lessons can we learn from the banks and apply to our own finances? Well, if we start to mimic what the banks do and what the wealthy do with their money, I would say we're headed in the right direction. Banks and other savings institutions who remain healthy put tried and true financial advice to work. Like this. They think long term, resisting the short-term gains and speculation. They anticipate and prepare for costs, including unlikely losses. They save money in long-term assets with gains that outpace inflation. They build equity and ownership in real assets, such as life insurance and real estate. They avoid speculation for short-term gains with high risk. They reduce, defer, or even avoid taxation altogether by remembering that it's not so much what you earn, it's how much you get to keep. And don't forget the Buffett rules. Number 1, buy low. Number 2, sell high. And number 3, never lose money. The trick to building wealth is to do what the financial institutions do, what the wealthy do, and stop listening to people that have something to gain from you investing with them. Remember what I just said? Don't always listen to what the investors tell you to do. That goes along with a quote that Will Rogers said best. He said, "The problem in America isn't so much what people don't know. The problem is what people think they know that just ain't so." So now that you've learned what the banks do, what the wealthy do, and even what a lot of companies do with their capital, why aren't you doing the same thing? And I think a lot of times we really have to look at this and we have to ask ourselves why we are told to do one thing and everybody else, including the wealthy, is doing another. And the answer comes down to you and everyone else out there have been taught to give up control of your money. You've been taught to give up your best dollars to somebody else so that they can benefit from that money today while you have to wait till someday later to get back the weaker dollars. The number one thing you need to do is change just one thing and change where your money goes first and put your money where banks and the wealthy have been putting their money for hundreds of years. And that is specially designed and engineered whole life. Start your privatized banking policy today. We can help you at the Money Multiplier, so let us know and we'll send you a 90-minute video telling you exactly how this works so you can do that one change and change where that money goes first so that you mimic what the wealthy and the banks and the credit unions and everybody else that is in the know has been doing for a long time.